This is the first video on Unit 4, the global economy. The global economy covers international trade, exchange rates, balance of payments, but also the second half of the global economy unit starts to look at development economics and the economics of developing countries. This introductory video is Unit 4.1, and we're just looking here at the benefits of international trade. It's an AO2, so there's no discussion to be had at this point, but actually international trade in general is quite a controversial sort of area these days of political turmoil that we've got around the world, discussions to be had on trade sanctions, tariffs, quotas, trade relationships between the US and China, obviously the Russia-Ukraine sort of conflict. So it opens up a number of questions about the benefits of international trade. So even though it is an AO2, looking at these benefits here, it's just descriptive explanations of the benefits. It would be advisable to think about this in a much more evaluative way, particularly as you move through the unit. So look, here's a list of the various benefits of international trade according to your subject guide. What I've done is just sort of covered those in a number of slides here that you are supposed to receive sort of increased choice, greater quantity and quality of goods and services available if you engage in free trade. It's more competition and all the benefits of competition in terms of efficiency and lower prices. Countries specialize, more research. It opens up competition to your domestic monopolies, for example. It's not a bad thing in itself. Tied in with that, this whole idea of economies of scale, being bigger is better in a way. For businesses, that is, you get lower prices, average costs come down. So smaller countries who have got a relatively limited domestic market might be able to benefit from engaging in more overseas trade. It's the engine of growth. I mean, if you looking at developing countries over the years, and South Korea is a great example of this, a country that focused on export sector, particularly producing products that were income elastic for the rest of the world, technology products. That really did make a significant difference to the South Korean economy in the 1970s, 1980s. Living standards, obviously these are all connected to each other. There's a theory of comparative and absolute advantage that's just for high-level students, and I'll cover that in a separate video to show how specialization will improve income levels and GDP output. Foreign exchange, obviously, when trade takes place, there's money changes hands in terms of foreign exchange. It does enable countries to earn foreign exchange, which they can, of course, then use to spend on imports, maybe even to invest overseas. Lots of political reasons, and you'll cover this a little bit more when you look at economic integration and the motivation behind, for example, the European Union was primarily driven at that time for political reasons and to try and encourage economic cooperation between the countries. Diagrams that you'll need both higher level and standard level, these ones here just indicate when a country will export and when it will import. Now, this situation here, you've got the domestic demand shown and domestic supply, and the world price here is shown, and when they meet, the world market price for bindles is exactly the same as the domestic price. There will be no sort of reason, motivation for trade to take place at that point. If you look at this situation here, though, where you've got a domestic supply, domestic demand producing a domestic price down there at PD, and the world price is above that, if that's the case, there is then the motivation and encouragement for that country to export the product, and they would export according to that world price. So domestic producers would supply here, and domestic demand is here. So the difference between that is available to export and to be sold overseas, and to create export revenue, of course. In this final third diagram here, you've got domestic demand and supply showing domestic price is above the world price. So this country is probably not as efficient at making this product as other countries are around the world. In this situation, the domestic demand at the world price is here. Domestic supply, though, is only there. And so there's excess demand, and that would encourage the imports of this particular product into the economy. And so those diagrams are needed for both HL and SL. HL, this is just for you. There's a little bit of an addition, which is for paper 3, sort of calculations of various areas. So let's just take a look at sort of similar diagrams again. Here you've got the world price above the domestic price. The world price is at $7. Domestic price will be down here at 5. Things that you should be expected to do is relatively straightforward. Looking at this world price at 7. Domestic supply is there at 100. Domestic demand is there at 20. So the difference between the two is 80 million units will be exported, and they'll be exported at a price of $7. So you are able to calculate this area. 7 times 8, $560 million worth of export revenue that the firms or the country will receive as a result of exporting this product. Now, that third question, who wins and who loses? Well, obviously the domestic producers who export this product will be winners. But let's make a note of the fact that domestic consumers now have a more limited quantity in which to buy, and they have to pay a higher price for it. So in a sense, being an export country means you've got less goods available for your domestic consumers, and they'll pay a higher price. Similarly, we could look at a situation where the world price is below domestic price. So here we've got a world price of 3. Again, we've got domestic demand out here at 100, domestic supply here at 20. So we've got an excess demand of 80 million units. This will show imports now. So we will import the excess demand, and we'll spend on these imports 3 times 80, so $240 million importing this particular product. Again, we sort of got winners and losers. Now it's the consumer who's more of a winner, paying a lower price. They're able to buy a large quantity of the product, but domestic producers are the ones who are sort of squeezed a little bit. They sell fewer units than they would do if it was just a more insular economy with no international trade, where they would sell at a price of 5 and they'd sell 60 million units. Now they don't. They sell at a price of 3 and they only sell 20 million units.